Hey everyone, it's John here from Strictly Business, and today's topic is how do stocks work? Okay, so we're going to start out here with two guys, Bob and Jeff. Now, Bob and Jeff have the dream of making a company that sells apple trees. Bob and Jeff decide to become equal partners and each own 50% of the company, as seen in this pie chart. 50%, 50%. Bob's 10 shares and equally Jeff's 10 shares. So, you may be asking yourself, what exactly is a stock? So, a stock is a share in ownership of a company. A stock is a general term used to signify a stake in ownership of something, while shares are used to specifically denote how much ownership a person has in a company. That sounds a little complicated, so let's explain it in terms of pizza. Here we have a full pie of pizza. Each piece of pizza represents a share of the company. This is 100% of a company. So let's say this pizza or company is worth $8 total. And let's say that each slice of pizza counts as one share, which means that there are 8 shares total. So simple math dictates that if the company is $8 worth and the company consists of 8 shares, each share is now worth $1 each. Now, someone called an investor decides that he wants a piece of the pie. So he buys one slice of pizza, in this case 1/8 or 12.5% of the pizza. He pays $1 to buy the share, and he now owns a piece of the pizza or shares in the company. So stocks work in a very similar way, except instead of pizza, we'll be using a pie chart. Furthermore, there are normally hundreds or thousands of shares purchased at a time, not just one share at a time. So now the question arises, how does this all relate to the real world? The selling and trading of shares happens when a company needs money. Let's take Jeff and Bob's tree company, for example. Jeff and Bob need to raise money to buy more trees, so they come to someone called an investor. Now, you may ask, how do they get money from this investor? The answer is simple. They issue more stocks for the investors to buy. So before we get into this, let's take a quick refresher on how Jeff and Bob's company is set up. So Jeff and Bob each own 10 shares in their total stock of the company. The company has a total of 20 shares, giving Jeff and Bob each 50% ownership in the company. Now, when Bob and Jeff's company needs more money, they will issue 10 more shares into the market at $10 per share. There are now a total of 30 shares of the apple tree company, 10 owned by Bob, 10 owned by Jeff, and now we have a new 10 unowned shares. So, because there are 30 shares instead of 20, Jeff and Bob now only own 33% of the company each. The new shares released are unowned, and investors can come and purchase shares. Greg, the investor, comes along and says, I want to buy these shares. I'll buy all 10 shares on the market for $10 each, for a total of $100. Now Greg owns 10 shares, which puts him on the same level as Bob and Jeff, who now all own 33% of the company. Now what does Greg get out of this transaction? In other words, what is the benefit of owning a stock? There are two main benefits to owning stocks: capital appreciation and dividend income. Capital appreciation is a big term, but basically it means to increase money. Capital is another word for money, and money that's normally used to invest. Appreciation means that it goes up in value. For example, let's take Greg and the apple farm. If the apple company does well, meaning it sells a lot of apples, the company's value will increase. If the company's value increases, it means that the stock price will also increase. Gregory bought 10 shares at $10 a share. Now the share price is $20 instead of $10. His capital, the $100 he invested, now in the form of shares in stock, has appreciated to $200. Gregory can now do two things. He can sell any amount of this stock and get $20 for each share he sells, or he can keep his stock in hopes that it appreciates even more and for the dividend income, which is also quite a bit of a risk. Well, Now we know what capital appreciation is, but what is dividend income? Dividend income is the second benefit to owning stocks. If the company is doing well, the company's officials, in this case Bob and Jeff, can choose to reward the stockholders by giving them income. This type of income is called a dividend. For example, Bob and Jeff can decide to pay the shareholders 4 cents per year on each share owned. Greg would then get 40 cents a year simply because he owns 10 shares and he's earning 4 cents per share on appreciation or dividend. And that brings about the conclusion for this video. How do stocks work? If you enjoyed this video and would like to see more quality content, please like and subscribe. And as always, this was John here from Strictly Business, signing off. Until next time.